Hey gang, welcome to another episode of Value Added, the real estate podcast. On today's episode, we're chatting with Nels Larsen. Nels is the founder of Guidance Accounting, and he has a lot of experience working with real estate investors, primarily in cost segregation studies and depreciation recapture, which we will discuss today. So without further ado, let's get on with the show.
Welcome to Value Added, the real estate podcast where we speak with the brightest minds in the world of real estate who provide, create, and realize value in an ever-changing market. And now your host, Nick Walters.
Let's dig into the topic of the day. You're a CPA by your background.
Last time I checked, yeah.
And you've been expanding your business in the world of real estate, and we want to talk about cost segregation first. It's such such an important part of the world of real estate in mitigating your tax liability, in being able to write off things that you probably didn't know you could write off. Drilling down into the screws in the walls. But anyway, so tell the listeners a little bit more about what cost segregation is and how it can be utilized when investing in commercial real estate.
Sure, absolutely, Nick. So cost segregation, or sometimes you'll hear nerds like me might shorten it down to cost seg, or real estate folks might just say cost seg or cost seg study. Really what that term is telling us, what we're doing is we're looking at, let's say you spend $5 million on a building. So we know, first of all, that we have to separate the value of the land that the building sits on from the building itself. And for tax purposes, as most listeners probably know, and I'm sure you know, we cannot depreciate land. We can depreciate land improvements, and we'll get into that in just a moment here. But so we start off with this idea: we've spent $5 million on a piece of property, whatever it is. It could be an apartment building, could be a warehouse, could be a professional office building. And obviously, it's going to look a lot different if it's sitting in Manhattan versus if it's sitting in Lenexa, Kansas, in the middle of the country, or in even more remote locations. But so first off, we want to make sure that we're getting the value of the land carved out correctly. And with a cost segregation study, what we're doing is, okay, so we know the value of the land is X, and then the value of the building is Y. But as you know, and as listeners probably know, for tax purposes, IRS says a commercial property, so warehouse, office building, medical, dental building, those properties have to be depreciated over 39 years. If I had 39 years left, I'd be up and down. I'd be so excited right now, but I don't know if I do. And if it's a residential property, 27 and a half years is what the IRS says we have to depreciate over. So those are both really long periods of time, I think, from any investor perspective or owner perspective. So what cost segregation does is, back to that example, $5 million piece of property, let's say $1 million gets allocated to the land, $4 million is allocated to the building. Okay, but we have all these other asset classes within the tax code that we can allocate some of that $4 million purchase price to. And technically, there are 9 asset categories. You've got the shell of the building, you've got HVAC, you've got electrical, you've got plumbing, and there are a few others that I'm forgetting off the top of my head. But we don't want to turn everyone into cost seg experts. We just want people to have an idea what's going on. So with cost seg, then you have somebody. Sometimes they're a CPA. Sometimes they have more of a background in engineering, but they've had some accounting training, where they can perform these cost segregation studies. I do not perform them myself. I don't have anyone in my firm that does them specifically, but I know it. And I would just say for your listeners, it's important to know when you need to ask more questions or explore more about would a cost seg study be beneficial to you or your investor group. I know a lot of CPs out there that would say that every property that a syndicate purchases or an investment group purchases, you should pretty much automatically do a cost seg study. Some would say, well, let's look at the facts and circumstances, but it's certainly something that you should consider on every property. And to come back, and I apologize, I went down a little bit of a rabbit hole there, but to come back to your question, then what we're doing, we're taking that $4 million purchase price, and we're going to try to break out as much of that from the 39 year if it's commercial or 27.5 year if it's residential, and allocate that to these other asset classes, which may have a 5-year, 7-year, 12-year, 15 or 20-year life. And these other asset categories like land improvements, parking lots, landscaping, did we actually, plant trees, move dirt? I mean, when you think about it like a golf course, I mean, most of what a golf course is land, but there are tons of cost segregation opportunities just in a golf course because that land, most of it has been pushed around or moved around or regraded or something, in the not too distant past.
Which are all considered land improvements that you were just referencing a second
absolutely.
ago, right?
Yep, absolutely. So, right now we're sitting in this kind of gravy area with the tax code where a few years ago, with the big tax bill that was passed at the end of 2017, effective for 2018, we have what we call 100% bonus depreciation. So, irrespective of the fact that like land improvements would be depreciated over 15 years, with the 100% bonus depreciation law that came to us a couple of years ago, anything that's got a life of less than 20 or 20 years or less, I should say, qualifies for 100% bonus depreciation. So if you've got a $4 million building and you can carve, let's say, another $2 million into these various asset categories that are 20-year or shorter lifespan per IRS code, then you've got $2 million that you can take bonus depreciation on today with the tax return you're filing now. And when you do a cost segregation study, I've had clients come to me or, heard stories about people that they buy a building and they're like, well, when should I do a cost seg study? Well, certainly look at it right away when you make the acquisition, but you don't necessarily have to do it right then and there. You could do it a couple years down the road. And people are like, well, but if I do that, do I have to amend my prior tax returns? And the beautiful answer is no. There's a one-time adjustment, a 481A adjustment for those people who are afraid they might get that question on, on tax jeopardy later on. 481A adjustment allows you to put that kind of one-time catch-up bonus depreciation or bonus number on the tax return for this year, even though you're doing makeup depreciation, say from let's say you're in year 4 of your deal, and you didn't do a cost seg study till just now. Well, we're going to be able to take all that makeup depreciation now in year 4 without having to worry about going back and amending those, years 1, 2, and 3 tax returns, and all your investors get new K1s, and they got to amend returns, and people might be happy to get money back, but it's a lot of hassle, so you don't have to do that.
So during the year that you're performing the cost seg study, you could very well realize a paper loss with that additional write-off. That predates to that's retroactive to say day 1 of the acquisition. Is that correct?
That is absolutely correct, Nick. I had a client a couple years ago. So I think about five or 6 years ago, he purchased a strip mall. Let's say his purchase price, I think it was actually pretty close to, the number we're mentioning, $5 million. I took a look at it and I'm like, I think, we should look at doing a cost seg study. And he was new to me in like year 3 of owning this piece of property. And so we did a cost seg study. We went out to the marketplace. We got, quotes from cost seg providers, selected one to do the cost seg study, did the cost seg study. And with that investor, I think when we, implemented the cost seg numbers into the current year tax return, I think we wound up getting, I know we had about $140,000 tax refund that we got. So it was pretty significant for him and would be for a lot of investor groups. One thing I should mention, it's not cost seg specific, but since we're talking about real estate and allocating, purchase price, one thing that cost seg can generally not do is if you have over allocated too much of your purchase price to the value of the land. And if you're a couple of years into the deal, what happens is when you file 2 tax returns, the IRS says you have established a method, even if it's an incorrect method. And so at that point in time, if you allocate too much of your purchase price to the value of the land, you're stuck. A cost seg study cannot go in and carve out value away from the land and into the building, where then it can be, further allocated into these shorter lived asset classes. So I would encourage every real estate investor out there, every real estate investor group out there, that when you acquire a piece of property, make sure that you have, obviously you have to play by the rules. You need to allocate, a correct amount to the value of the land. You can't go $5 value of land, $4,999,995 value of the building. But once you've established the value of the land, you can't go back. And cost seg service providers will tell you that they are not appraisers, and so they are not professionally qualified to appraise what the value of the land is based on your purchase price. And so you want to make sure that you get that allocation correct from day one, because you might wind up, and that was an issue. I've seen that a few times where, so I recently had a client, $2 million acquisition price. Their prior accountant, God only knows why, decided to allocate half the value to land and half the value to the building, with no substantiation. We looked at property tax statements or anything like that. It just felt right in the moment. Who knows? So we went back, we did a cost seg study, and we got a tremendous benefit for them in 1 year. But unfortunately, we couldn't do anything about it. And honestly, I figure that the value of the land is probably worth $500,000. So they probably allocated $500,000 too much to the value of the land. And there's nothing we can do to fix that. So sorry to get off cost seg specific, but since we're kind of in a related topic, I want to make sure we get that out there so people are aware of that.
That's really important to note, that you can't just put a number on the value of the land, and you really have to I would assume that if you're trying to determine the value of the unimproved land, you would have to go into the tax the tax records, right? The assessed value of the land.
Yeah, property tax records, if there's like a county assessor's valuation, that would be a good starting point. Depending on the size of the property and the dollars involved, if you're doing an appraisal on the front end, because maybe there's going to be a bank loan involved, I would ask the appraiser, and I don't see this very often, where the appraisers actually split out the value of the improvements versus the value of the raw land. But if I were an investor, or if I was buying a piece of property just for myself for investment purposes, I would ask the appraiser to do that. If they say no, then yeah, look at property tax records or, county assessor's records.
Gotcha. Yeah,
so you have some kind of substantiation, if the IRS were to ask the question down the road.
Sure. Yeah. No, that's very, very helpful. And I think that's something that investors have to be familiar with as they're going through the initial stages of putting together a cost seg study. So let's go back to our hypothetical example. So I bought a $5 million building. We're allocating $1 million of the purchase price to the value of the land, and then the $4 million to the improvements on the land. 4 years go by and we've been operating this asset, and we get it to a point where we've executed our business plan, and the next stage is a liquidity event. Let's just say we're selling the asset. We're going to be very, very happy because we just took advantage of the cost segregation study that we did a few years prior, and when we sell the asset, we're going to realize all of that savings, and we're going to put a big check in our pocket, or we're going to roll it into another asset in the form of a 1031 tax exchange. That's all. That's all very true, right? But you're going to tell me no.
That is correct. The cost segregation is it's a very powerful tool. It's a tool that every real estate investor should have on their hanging on their tool belt or sitting in their toolbox, and at least know when to ask more questions of an expert. But when you have a liquidity event, one of the things that happens, of course, in your scenario, we sell for profit. I mean, that's the whole idea, right? And the bigger the profit, the better. And what happens is we've got the tax code says, well, wait a second here. If you took depreciation on your real estate, we need to factor in depreciation recapture. And there's section 1245 and section 1250 depreciation recapture for, again, more tax nerds out there. And 1245 is recapture that's applied to any depreciation that you took. And 1250 is applied to accelerated depreciation that you took. So accelerated depreciation in tax lingo typically means any amount of depreciation that you took above and beyond the straight line depreciation. So, we said a few minutes ago that for tax purposes, IRS says commercial property gets depreciated over 39 years. That's 39 years straight line, and 27 and a half years straight line for residential. So by doing a cost seg study and by pulling out, we had that $5 million purchase, $100 million sits in the land. We don't do anything with that, but we allocated $2 million of our $4 million remaining basis into shorter lived assets, and we did bonus depreciation that we took back in year 1 or year 2. So with any of that bonus depreciation, we're going to have to do depreciation recapture. So we're looking at, if it's 1245 or 1250, we're looking at ordinary tax rates. But so really the benefit in that scenario of doing a cost seg study, it's time value of money. I would imagine any real estate investor, any investor even contemplating real estate, understands time value of money, discounted cash flows, net present value stuff. So that $1 today is worth more than $1 in 4 or 5 years down the road. So, because hopefully you're going to be able to leverage that, you're going to be able to take the $1 today and get a rate of return that's going to be, greater than inflation or greater than your discount rate, for the $1 you're going to get in 4 years. So then, in that scenario, then that's the benefit of cost seg is, hopefully we still have been able to take that, whatever our depreciation tax savings was, but from as a result of doing a cost seg study, and deploy that capital into other investments or pay off, high interest debt or something, that's going to make sense from a financial leverage perspective.
Gotcha. Yeah, so, that's all really, really helpful information. Just getting the investor prepared that if they end up doing a cost seg study and taking advantage of accelerated depreciation, knowing that they're going to still have to pay those taxes through depreciation recapture at a liquidity event. That could also be a refi or an outright sale. Is that correct?
So if you refinance a property, that is typically not that's just a recapitalization event. That's not a taxable event per se. So if you just go to your bank and, let's say you were paying, 5% interest and you're going to get a better interest rate and for some reason you're able to get a longer term. So you're going to have better cash flow. Plus you're going to get a little cash out of the property because maybe the property has appreciated significantly. That in and of itself won't be a taxable event. It certainly could affect your basis as an investor in your investment, which is, a whole nother topic of conversation, tracking, basis and investments. But, so, typically it's a sale, a 1031 exchange, because you can have 1031 exchanges where most of the investment goes into 1031, but you still have, a partial taxable event from that sale.
Gotcha. Before we get into the last segment of the show, do you have any other parting words about cost segregation or straight line depreciation or depreciation recapture?
I would say that the other thing to take in, to consider is because of depreciation recapture, and depreciation recapture gets reported to investors on K1s. But you need to look at tax planning as not it's not a one time a year. It needs to be kind of an ongoing process that you do over a period of years, because you might find that I got a tremendous tax benefit in year one from this real estate investment because I got to take some depreciation recapture. Awesome. But you might find if your income continues to go up, and then you have depreciation recapture, say in year 4 or 5, when we have a liquidity event and have a hopefully windfall, you might find that your personal, as an investor, that your personal tax rate, ordinary tax rate, has gone up. And so it's possible that you could wind up paying more in tax in 4 years. Now, hopefully with net present, with time value of money, as we mentioned, that won't be the case. But that's something to keep in mind. It's not you have to analyze not just each year as a definite time period, but each year and then going forward, and probably having a 5 or 10 year plan, just so you're aware of these things. So you go, oh yeah, if we sell deal X over here in year 5 and we're in year 3 now, I need to be aware I could have some depreciation. I'm probably going to have some depreciation recapture because we wouldn't sell it for a loss, And maybe at that point you go, well, could we do a 1031 exchange? And then we don't have to worry about depreciation recapture.
Nels, we're going to close out this show with the hard-hitting questions. These are the questions that I ask every one of our guests. I always like to start out with, what is your why?
What is my why? Wow, I thought I was talking with Nick Walters at the podcast.
I stumped you. We're getting deep.
Simon Sinek. No, my why is I like to help people. My dad passed away at a somewhat early age, and he didn't leave much money. In fact, we had tax debt when he passed away. You could say poor tax planning. But my why, because of that, my wife wound up going into life insurance because my dad didn't have life insurance. And my passion is to help people have their affairs and I'm not a financial planner, but just from a tax and business perspective, I want to make sure that my clients have their affairs in order. And, a good CPA is part of a team. You can't be all things to all people. And, like I do specialize, probably half of all of my firm's clients somehow are involved in real estate investors. The other half are entrepreneurial small business owners. But my why is just helping people. And I know it probably, on a personal level, probably gets me into trouble because my wife says I probably give away too much information. I give away too much time. And you know what? At the end of the day, my goal isn't to be rich. It's just to die knowing I helped people and hopefully people had fun and I had fun along the way. So
did you get into the accounting field because of your father's experiences and what he left for the family essentially?
I didn't. So I have a confession to make. I know we're not in church right now, but my confession is I don't have an accounting degree. My degree is in economics. And when I got done with college a long time ago, the economy wasn't so hot. And I wound up going into accounting. Somebody suggested that I take some accounting classes, and I did, and I liked it. And originally, I didn't want to be an accountant because my father had spent most of his working career as an accountant. And so, a lot of people don't want to do what their parents do, right? It's like, oh, my dad does that. I don't want to do that. But so the long answer to your short question is no. I did not go into accounting because of my experience with my dad. But I just went into accounting because I like numbers and I like helping people.
Nels, what is a recent book or another piece of media that you've consumed recently that's added significant value to your life or your career?
There's, I would say a book that I read a lot of books. I probably read a couple books a month. There's a book on my list that I need to read called, I think it's The Infinite Banking Concept by Nelson Nash, which is something that I've only kind of played around the edges of that. It's the idea of using whole life insurance to kind of become your own bank, so to speak. Some people refer to it as the infinite banking concept. I think Be Your Own Banker maybe is another book out there. But I would say a book that I go back to and I read, I might even read this a couple times a year because it's so short. And I can't think of the authors. I think it's a couple of authors, but The Go Giver, which is it's like a 130-page book or something really short like that. It's kind of written with the giver's gain concept or principle. But I believe, for example, I've built my practice from networking. I haven't purchased any client lists or anything like that. And I've always felt like so many things in life, like a health club membership. You can belong to a health club. They'll gladly, pull their monthly dues out of your bank account. But at the end of the day, you don't get a benefit if you don't go. And I've always felt maybe it's a karma thing that the more people I help, eventually that comes back to me. So,
yeah.
So maybe it's selfish. I'm not sure.
No, that's very true. Nels, knowing what you know now, what's the number one piece of advice you would give your 21, 22-year-old postgraduate self?
Knowing what I know now, I would say take every penny you can and save it, whether it's in a retirement plan, get into more. I've done some real estate investing myself for sure. I wish I would have done more earlier. And I'm, full disclosure, I'm 50 years old. So, I probably have, 15 years left on the runway, something like that. But, it seems like it doesn't matter if I talk to someone who's 35 or someone who's 75. I almost always hear, I wish I would have saved more earlier, or I wish I would have bought more single-family homes earlier. I think a mutual acquaintance of ours, Stace Casaria, he's up in New England in the Boston area and has owned a number of single-family homes. I know he made that comment to me in the last couple months. I wish I would have bought more single-family homes 25 years ago. Yeah, so that's what I would tell my 21, 22-year-old self.
Nels, how can our listeners get a hold of you or learn a little bit more about you and your practice?
Sure. You can certainly feel free to check out the website if you want to do it and not have to have a conversation with a real person. So the website is www, of course, that's redundant, right? guidanceaccounting.com. I text, I talk on the phone. My daughter's in their mid-20s. I can call them. They won't answer. They won't pick up. They'll watch the phone ring and roll over to voicemail. But they'll text all day long. So my phone number is 612-618-5299. I'm in St. Paul, Minnesota, but our clients are all over the country, Florida, California, and everywhere in between.
Awesome. Very, very helpful info. Nels Larsen, we really appreciate the time and thank you for providing your value today.
Absolutely. Nick, I hope I was able to, as your name suggests, add some value to the Value Added podcast for your listeners. Thanks again, Nick.
Thanks for listening. If you enjoyed this episode, please make sure to leave a rating and a review, which will help us introduce the podcast to other listeners. Also, don't forget to subscribe to our YouTube channel, which will give you access to other episodes you may have missed. Lastly, if you'd like to learn more about investing alongside us, then head on over to valueaddedpodcast.com. Have a great day, and we'll talk to you next week.